is our investment team project. So looking at the returns of these asset classes and indices in 2024, you see that the best returns came from Bitcoin at 140% return, gold at 37% return, and the NASDAQ at 29% return. And the worst returns came from crude oil futures losing about 4.5%, the FTSE 100 gaining about 5.5%, and then Nikkei gaining about 9%. The overall trends that we noticed from this data was that inflationary hedges, quote unquote, can be argued whether they are or aren't, but Bitcoin and gold were at the top of the list. This could be a sign that investors are pricing in a high inflation environment in the future. Another trend we noticed is that U.S. equities outperformed foreign indices greatly, with 30% return from the NASDAQ and 25% from the S&P, compared to the Nikkei only gaining 9%, which is the Japanese indice, and 5.5% from the FTSE 100, which is the British indice. This is a consistent trend for the past 15 years that U.S. markets just overperform foreign markets greatly. And then another trend we noticed was that there was just an overall higher return on average from almost all these indices. You'd expect the historical average for like the S&P is around 7%, 7.5%, and in 2024 it returned 25%. This has been a common trend ever since the COVID crash. We've just seen year over year 20+% returns from the S&P and the NASDAQ. So we're just seeing overperformance these past of 2024, and that's been a trend. Another trend we noticed is that the large caps were really leading the way in the U.S. equity market. The NASDAQ and the S&P outperformed the Dow and the Russell 2000, showing that it's really the large caps that are pushing the market higher more than small cap growth and industrial growth. Our outlook for 2025 is a somewhat neutral outlook. We believe that the Trump administration and their tax cuts and tariffs will provide too much of an inflationary pressure to keep the rates from being able to be cut. The market is seeming to price in a couple more rate cuts in 2025, and we believe that just with the protectionist policies of the Trump administration, that the rate cuts won't be able to go into effect. You would expect more growth in a full Republican majority government, but we think that the inflationary pressures will counteract that growth. There's also an uncertainty about U.S. futures, so we expect that possibly foreign markets might make a comeback with money moving into other markets and moving away from U.S. indices. For the Buffett indicator, looking at the Buffett indicator, it is a measure of the market cap of the S&P 500 over the U.S. GDP. It's similar to if you did for a single stock, like a PE ratio. It's pricing how much we are valuing companies versus how much output is occurring in the United States. Looking back at it historically, whenever it reaches around that 150% mark, we've seen downturns, like in 2000, the dot-com crash, and then even in 2008, we saw it around 110 to 120%, and then a down crash. Ever since about 2020, we've been above that 150% Buffett indicator, even after the downturn from the COVID pandemic. So we've been in an extended period of being over that number, and we still haven't really seen a large downturn. This would indicate that U.S. stocks could possibly be overvalued compared to historical averages, and we might be headed towards a recessionary period. Although some people argue that there are limitations to the Buffett indicator, that since its GDP is a backwards-looking figure while market cap is a forwards-looking figure, your qualifying. You're trying to pay for future returns, so they're not comparing apples to oranges there. That the market cap is more of a future-looking figure, and then the GDP is measuring the production of the past. And another one is that these U.S. companies are really worldwide companies, so if people question whether the U.S. GDP figure is the correct number to use to measure, when many of these companies are doing over half of their business outside of the United States, they question whether this is the correct figure, or the U.S. GDP is the correct figure to use to measure against. So looking at our probabilities here, for the severe recession where we would see a 30% drop in stocks, we put in a 15% price target, or 15% probability. The mild recession was a 30% probability. Normal growth was 40%, and the boom was 15%. When you multiply that by the return that would occur in that situation and add them together, we get the expected return of 1% for 2025. And then using that expected return, we calculated the variance in the standard deviation of this situation to come out to 18%. So in this situation, we have quite a high standard deviation, showing that even though we expect 1% returns, there's a possibility that returns could be much higher or much lower. In the severe recession scenario, we priced in that this would happen if inflation rose quickly. This would have forced the Fed to raise rates. If there's a lot of political uncertainty leading to money being to be taken out of investments, the inverted yield curve that we currently are in, where there's just a distrust in the market so the current borrowing rate is higher than or the later borrowing rate is higher than the current borrowing rate. And if we saw large-scale AI layoffs, we could see just a rising unemployment while inflation's rising would lead to just a severe recession scenario. In a mild recession scenario, we've priced in that the uncertainty stops the money from piling into the market. Investors start to take profits from this 5-year bull run we've been on, and so then the Fed would maintain rates, and the market would just cool off a little bit. In a normal growth situation, the pro-business policies would just allow the market to continue growing. It would just slow down a little bit. Government keeps printing money and stimulating the economy. So we just see this normal growth. And then Trump's protectionist laws allows U.S. business to succeed. So you just see this normal growth. And then the bull run continues. If inflation stays down and the Fed is able to cut rates quite a bit, like the 2 cuts that some people are pricing in, then you could continue to see a boom in the economy, maybe around and get that 30% return. And if large advances in AI allow corporations to reach record profits, then you would possibly see this 30% boom. Given that information that we priced in, we put a hold rating on the U.S. market, on U.S. equities. Even though the return at 1% is low, we just calculated such a high standard deviation that we aren't able to put a strong opinion on buy or sell. So we found that hold would be the best opinion. We think that possibly 2025 could be a good year to increase weights in foreign equities, foreign indices, could possibly, or inflation hedges like Bitcoin or gold, and then possibly increasing your fixed income securities. We expect quite a stagnant year with just markets cooling off in general. This is not financial advice, and long term, we think that buying U.S. equity markets and holding it for the long term is the best investment advice. So if you're looking for long term, then it's better to just buy and hold for the rest of your life instead of trying to time the market overall.
All right. Sorry about there being no camera. Couldn't really figure that out. But I was assigned with part 3. And then for task 1, it asks us what is short selling? And my answer to that was a short sell is a trading strategy where an investor bets on a stock price that will decline in the future. Instead of buying the stock, the investor borrows the shares from a broker. There's 4 steps that I found key to it. First off, you want to borrow the shares from the broker. Second off, you sell the borrowed shares. You sell them at the high price that you think it is at right in that moment, and you hope that it declines. You maintain a margin. Most brokers are going to require you to post collateral in case the short sale goes wrong. And then in the end, once you're ready to wrap it up, you buy the shares back at what you hope is a lower price, and you keep the remaining difference for each part that you bought. In task 2, we were tasked with short selling a stock. We borrowed 100 shares of PLTR from one of our brokers. We purchased this stock at $79.89 a share. The purchasing price came out to $7,989. We took the original price of the stock and times that by the number of shares we borrowed. And then we're required to post an initial margin. So for that margin, we were required to post at 60%. So we took the $7,989 times 60%. That came out to $4,793.40, which is the margin required. When you add those two numbers up, you get $12,782.40, which will be the total buy-in for this investment. Task 3, we're supposed to look at what would happen if the stock price rose to $83, which is the last thing you really want to happen in a short sale. So with $83 being the new market value, we had to find the new total market value of our investment, and that came out to $8,300 instead of the $7,900 or $7,989. So what we do is we subtract our total buy-in from the new market value. That gets us $4,482.40. And then we divide that by the new market value once again, which gives us the total margin that we currently have posted, which is 54%, which remains above the 35% maintenance price, which we'll figure out in part or in task 4, which is okay, but we don't want the margin to keep dropping. So in task 4, we're required to find the price before the margin call would happen. And what we did was the equity divided by the short position equals 35%. So $12,782.40 minus 100, P represents the margin call price, equals 0.35, which is the margin, times the 100 P. And then skip the next step. We get 12,782.4 equals the 135p, which is the margin call price. And when you divide those out, you get $94.72, which is the margin maintenance price. If the price of the stock rises anything above that, the broker will cancel the trade, and you will lose your collateral. Thank you.